Hey guys, welcome to another webinar, and I hope you're doing great. So last week, I didn't really see much asset that we dove into, but this week perhaps we'll see some opportunities that will be conducive for our style of trading. That being said, I'm just going to get straight right into it. Also, I'm experimenting with a new feature on YouTube. It's a podcast feature on YouTube. I think not every channel has it yet, but my channel has it. I've been invited to this new feature, so I'm testing it out. So it's not going to be the same exact way that I've been posting. It's called podcast. So I'm trying to move this weekly session into that podcast space and see how it feels. So bear with me within this transitional period. All right. But that being said, let's go straight into it. So for those that have been here before, you know the drill. And for those that are new here, welcome. And just before we get started, this is my own personal outlook to the market. I'm not saying this is what you should do with your money, but I would recommend that if you're taking any decision based on the information I'm posting here, you should consult with a financial specialist. This is just my personal opinion and my personal outlook to the market. That being said, what we look at here is there's a three-day strategy. One is called COT, one is called seasonality, one is called probability. Now, COT is called commitment of traders, and with COT, what happens is we get to see inside information on what the commercials are doing. So commercials are people that utilize whichever asset is it you're choosing on a day-to-day basis. It could be central banks, it could be a producer of gold, for example, or someone that owns a cattle, or whatever it is. Now, non-commercials are people like you and I that speculate on that move, on the move that we expect the market to go up or go down. The commercials don't necessarily need, to speculate if the market is going up and down. They're just literally trying to get the best discount possible for whatever they're buying. So if one commercial to another is like, I want to buy 100 cows, for example, they're like, okay, 100 cows, I want to buy it at this price, but I don't need the cows till 2 or 3 months from now. And then they pay that exact price. Now, if the price of the cow after 2 or 3 months has gone up, and that person bought at a lower price, then the person buying it made some profit or got some discount, let's call it that way. And if the price of the cows have gone down before that, after the time the person that bought it, the person, paid too much for it. So that's what the commercial is. And we pay attention to the commercials because they have more information than us non-commercials that we're just trying to make money off the movement of the asset. So that's equation one of the strategy. So let's look at gold, for example. So this is what a COT look like. I've spoken about the non-commercials, I've spoken about the commercials. You might be able to tell that this date is lagging, by 5 days at the moment. This report is released every Tuesday. And even with the 1 week lag that's in between the release dates, it is still accurate. So the way I use the strategy is this. I look at the asset and I look at commercials. I don't pay attention to non-commercials or non-reportable. I only pay attention to commercials and I look at the changes, right? Long simply means buy, short means sell, right? So all I do is commercials. What are they doing now? They're selling right now. They're adding 33,000 position into that place. So what I'm going to do is I'm going to put gold short, which means sell, right? Now, it doesn't mean I should just rush into the market and quickly go select gold and quickly go select sell. No, I'm not going to do that. What I'm going to do is I'm going to go to the next part of the strategy, right? Now, the next part of the strategy looks like this. Let me just pull that up, seasonality. It's called seasonality. Seasonality is basically the seasons. In the market, there's 4 seasons, Q1, Q2, Q3, Q4. And market move differently within all seasons. And you just have to know which season you're in and how market is most likely going to move within that season. If you understand the seasons and you understand that commercials are buying, the likelihood of the asset going up is high. And if you understand the season and commercials are selling, the likelihood of the market going down is high. So basically, so what we're going to do now is we know that gold is saying short. Now we're going to look at the seasonality to see if it's a short or not. So basically what we're gonna see right here, apologies, there might be noise coming in from the neighbor's house. So I'm still in Nigeria, by the way. So what we look at now is what we're looking at now is the seasonality. And this is what the seasonality looks like. It has 5 years, 15 years, and 47 years. That's average price movement within those time periods. And what we tend to do is we only want to take the market analysis or these trades when all three are aligned, right? Like here, for example. So you might notice those alignment lasts for a very long time. And that's because in the past 47 years, 15 years, and the 5 years on average, price still moves the same. And if price moves the same around this period, the likelihood of that happening again is very high. But most people don't know this because they're only used to looking at this, for example, and getting excited. Why you don't know that there's a bigger pattern behind the scene that's playing out. So if you have this information, this is good information. Now, we don't look at trades and take any way that all three does not align. We make sure that all three is aligned before we take that trade. This is my adaptation to the seasonality. Some people are used to just using one of it, for example, but I figured out the best way is if I use all three. Now, you can use one of it and it might be working for you because not every single time market is going to play out exactly the same way. But if you use one of it, it's fine, but I tend to just use all three. I find that works best for me. As I've said, this is my own personal way to look at the market. You can, utilize your own specific way or adapt the system to your own way. This is just for educational use only. So what happens here is we're looking for a short and we're looking right now on the 29. Now, what we do is we look here, we zoom in, we go to the 29th. I just highlight the regions I want to zoom in and the stuff zoomed in by itself. So I didn't do any magic. So yeah, 29. Now the market is saying sell, but from what we can see on the 29 and maybe possibly 30, 31st, is market might not be moving down, might be moving up instead. So for that reason, I would not trade gold. Okay, so I deleted off the CO2 report, and let that go. And the next thing I'm going to look at is another asset, for example, let's say CAD. I see CAD is going long, so I just put it down. There's CAD. And if you're looking at it, that why am I looking at it on one asset? It's because I'm looking at it in future. Once you know where one is gonna go, you possibly know where the other one is gonna go. So even if it's USD CAD, USD JPY, whichever asset it is, if you know where one is going, you already know where the other one is going. So next thing I look at is CAD. Let's check what CAD has for us. Same thing, and we're expecting CAD to go long. Doesn't look like way. So we're gonna delete CAD again. Next one, GBP. Now they're buying, they're selling a little bit here, but majority of it on buy, so go GBP. And then you do the same thing. Now, this is just for example's sake. If you really want to do your own analysis and understand the market better, you should go into the website. You should go to the website. So the website is business.dam empire. .co.uk. And then if you just go to /pricing, you will be able to get access to these tools and be able to do your own analysis yourself. Right. I'm just showing you what's possible with them. And there's still the probability which you haven't seen yet if this is your first time. If this isn't your first time, then go back to some of the previously uploaded videos. That way you can see the probability. And so we're expecting GBP to go long. So we're looking at seasonality, the period 29. Yeah, we're right here. According to this long is only gonna just last 2 more days and then it's gonna bottom out. So we're not gonna take that neither. So there's still many more assets to look into, but as this is just mainly for educational use only, that's how you use the tool. You just keep doing that until you find the right one. And then once you find the right one, you go to probability, which looks like this for the people that haven't seen it before. You go to probability, and then from the probability is pretty much straightforward. You just want 3 days in your direction, right? So probability looks like it's just a table, but it's basically a gambling way, or it's not gambling, but it's kind of like a casino way of looking at the market, basically. Knowing the percentages, what the odds are on the specific day. So with this now, for example, it's giving us the odd throughout the entire year, all the way to December. So you can come here and then look for the date and then see if that asset is in favor. So we're only going to take trades if they're 3 days in our favor. So like here, for example, 1 to 3 days in your favor, then you take that. Mainly because if you have a 59% chance of short here, 54 and 57, there's a high possibility that's going to go down. You know, the odds are already in your favor anyway. So that's what it is, what it looks like. So you can get access to all these tools and utilize all three simultaneously. You should actually use all three together. Right, and you can get that from the business.demipad.co.uk/pricing. Right. And there's one more thing I didn't tell you guys about, didn't tell you about. I don't normally come back to the technicals because it's not really necessary, to be quite frank. You can just use to plot your entries. But for those that are like, okay, where do I put my take profit and all of that? What you can do is go to indicators, insert indicators, average true range. I tend to use 3 weeks, so which is 15 days. You can use 14 days as a default. An average true range will give you a figure right here. You understand? And that figure is the average price movement in the past 15 days. So it's gonna be a calculation right here. So what it's telling you right here is the average price movement within the last 15 days. And from that, you can decide what your take profit will be, what your SL will be, and all of that. If you're looking at it from a 4-hour time frame, this is 43 pips, right? This is average price movement in the past 15 candles is 43 pips. So it will do the calculation of adding all previous 15 candles together and dividing the number by 15. Now, if you're trading the same way I do or similar ways, then you do it on the daily time frame. And what you want to do is, normally I tell people to do ATR times 2 or ATR times 1.5. But for daily time frame, you can see this is around 109 pips, right? 109 pips. And this one's about 43. When you see those dot in front, just literally ignore the last 2 numbers, focus on that. Just always ignore the last 2 numbers when you see it in this format. You know, the last 2 numbers. So in this case, it's 109 pips. So what you then do is you say 109 pips, and then if, for example, you're going in on the market on this day, you're going long on the market, or on the next day you're looking to go long on the market, you've done your analysis, and then you enter the market, at that's not really a good example. I'm looking for a candle that is long enough so we can pick it. All right. So let's say you're on this day, you look at going to the market long, right? So what you do is, if you didn't get in at the start right here of the market, wherever it is you get in, you do it. If you got in at the start, exactly, your stop loss is 109 pips, right? Very easy. Just put your stop loss at 109 pips on a daily. Now, because of this way we trade, we don't expect the market to go like this. We expect it to go in our favor, right? So what will happen is, because we trade long term, so we'll probably be in at the start of the move somewhere around here. Now, let's say here is 109 pips, for example. That's your stop loss. If you went in here, if market hasn't moved 109 pips against you, you shouldn't be out of the market. I mean, it depends on your account size anyway. If it isn't, heavy, then do what you need to do. But if you put your stop loss at 109 pips, ideally market wouldn't get there. Now, if this candle is the candle you're going in long and you entered right here, don't put your stop loss at 109 pips. I would suggest doing 109 pips plus how many you've gone in, right? Because you want to cover that 109 pips because that's the average price movement. If price does its average, the likelihood of price going towards that direction is now higher. So you wanted to make sure that whenever you're going into the trade from the start, you want to set your stop loss at that figure. So if you enter right here, you do that figure, ATR figure, plus how many pips you've already gone in on the daily or move towards your favor on the daily. If you get in on the lower side, let's say market pull down first, your stop loss is still 109 pips. You continue with the same thing, 109 pips. And then when price is moving to your favor, then you can move your stop loss to break it. All right, guys, that's all I have for you this week. I hope that helps. I'll catch you on the next one. And if you have any questions, leave it on the Telegram or message me directly on Telegram. Thank you. Bye.